Do you know someone with some land they'd like to sell and you want to know how you can help them and make money at the same time in the deal? Stay tuned and find out on Deal Architect Live. Welcome to Deal Architect Live, where we show you how to plan, create, and grow a real estate portfolio, a profitable real estate portfolio, no matter what your situation is. Let's get it. Now, today's show or topic is how to make money on a land deal. Now, of course, this is Deal Architect Live, brought to you by the Wolf Pack. And my name's Eric Parrish, by the way, and I'm a deal architect. I play one of the roles that of the 5 roles, using the Wolfpack method. Now, we discussed that last week, but we have 5 types of members in the Wolfpack. We have the deal architect, such as myself. We bring expertise, the team, the deal, and we help structure the deals with optimal risk and maximum profit potential for all parties involved. We have the wholesaler in the Wolfpack, and they bring the deals to the table, and they also bring other members or participants to the table to get the deal done. And we have the mortgage-ready landlord. They bring leveraging power to the table. They can qualify for investor mortgages. And understand there is a big difference between an investor mortgage, which is a non-owner-occupied mortgage, as opposed to a owner-occupied mortgage, but purchasing a house that you're going to live in. Those 2 types of mortgages are entirely different with entirely different qualifying criteria. So that's the mortgage-ready landlord. Again, they bring leveraging power to the table. And then we have the joint venture partner. They bring buying power to the table, specifically capital or cash to the table. Now, it may be from the cash reserves, it may be from a self-directed IRA, it may be from a line of credit, but they bring buying power to the table. And lastly, but not least, we have the home buyer partner, aka tenant. Yes, we in our ecosystem, even the tenant makes a profit in our deals. And the whole objective there, seeing as we're the only group or community on the planet that does this, but the objective there is to remove the adversarial relationship between the landlord and tenant. And we do so by allowing the tenant to participate in the profit sharing as well, because they bring an important piece to the table, and that is the cash flow, because they service the debt. And they also bring future leveraging power to the table, because many times they can't qualify for a mortgage right now, but within their plan, which all of us have, we call it a plan or asset accumulation plan. All of us have within their plan, they have all the steps it takes, and they have a closing date uh, 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 based on those steps to qualify for a mortgage in the future. So they bring future leveraging power to the table. So all of us bring something to the table, and we obviously we can play multiple roles, but it makes sense when you're starting out to choose a primary role to get started with. So with that said, if you are interested in real estate investing, we invite you to visit uh, the website thewolfpack.co and join. It's a free community, and get started with us, alongside with us, collaborating, creating long-term wealth with real estate. And we'd love to have you. So today's topic again is ways to structure land deals. Now, we had, and again, we encourage you to visit the website and send us your deals you want us to to chop up and illustrate how we structure deals using the Wolfpack method. And of course, that's what we call real estate collaboration. Everybody plays a role and we all win. We do no deals at all without everybody winning. And that allows us to severely reduce the risk. It allows us to uh, uh, make more money or participate in more deals than we could ever participate on our own. And some of us, it allows us to participate in deals that we could not participate at all before joining the Wolfpack. So we're excited about the things that we're doing, and we're going to bring this show to you every week for those of you interested in learning the craft of deal architecture, hence the name Deal Architect Live. So one of the members brought a deal to us. They had some land, or they knew someone with some land, and they wanted to know how they could help them by purchasing that land, because they want to sell it and also make profit themselves. And of course, that's what we do. So we're going to go over that deal today and discuss a way to structure it that made sense for this particular deal. Keep in mind, there are many ways to structure a deal. By the way, we have what we call the Wolfpack Real Estate Playbook, where we have a dozen or so strategies that we grab and use as a basis for structuring our deals based on the fact that we have every type of resource within the Wolfpack. We also have our team members. We have realtors. We have title companies. We have builders. We have appraisers. We have insurance people, mortgage professionals. Everything you could possibly need, we have in the Wolfpack. So you're not alone, and you can not only do deals you couldn't do on your own, you can do more deals than you could do on your own. So in this case, we're going to go over a deal today on ways to structure a land deal. Now, within the Wolfpack, again, I mentioned that we have a dozen or so strategies, and within this particular deal, we're going to use 3 or 4 of them. One being the land bank program, the other being the net zero program, and the other 2, a home now or the owner finance program. There's a mix of all of these strategies within this one deal, the way we structured it, or the way we're looking to structure it. And again, if you're interested in doing this type of stuff, just join the Wolfpack and let's have at it. So I'm going to share my screen. Here is the land deal that was brought to us today for us to chop up. Now, let me get rid of that. Now, as you can see, it is the circle here is what is the project. It's 3 acres. And I know, we wanted to know if we could have opportunity to buy this part as well. And we had a shot for a time, but somebody beat us to it. So now we're going after this 3-acre plot that was brought to us by a member. And I'm going to show you how we're looking at structuring this particular deal. Now, again, it's 3 acres, and you have single family homes in the front. You have patio homes, which are single family as well, in the middle there. And then you have some town homes in the back here. So the first order of business questions we need to ask is, does the land have utilities, access to utilities? And in this case, it does. So we have access to water, sewer, things like that. If not, we would have to put them in, and that means higher costs in development. And so we have access to that, but we do have to put in a road, one road in between, and we're looking to do 30 units. Now, next question again is, after that, you determine that, what type of home or what type of construction do we want to do on that? We already know we have to develop it. It would be better if they were just lots ready to go, but it needs to be developed. Now, because it needs to be developed, in this case, light development, that means we probably get better pricing. Because just like a rehab, the more work you have to do to it, the more value you can add by doing that work. Because the seller usually doesn't have the wherewithal or the desire to, or the capital maybe, to even do all of that work. So in this case, the development has to be done, and we typically get a better price. So they're asking in the mid maybe 150,000 for this. So we're going to use that price. Now, property type. What kind of units do we want to put on this? Do we want to put houses, single family houses? Do we want to put patio homes? Do we want to put townhomes? I would say, because the townhomes are right there next to it, let's put townhomes on it. Let's see what does that make sense? It does make sense because they're attached to each other, or at least very close to each other. You can get more units on there, meaning the lots can be smaller, and the more units you can get on there, the more profit you can make. So it makes sense to look at townhomes for this, and that's what we're looking at. So on this 3 acres, we're looking to get 30 townhomes on it. So that's how we look at this. First, does it have access to utilities, sewer, water? Is it in the flood zone? It happens to not be in the flood zone. In Texas, we have flood zones. So if it's in the flood zone, we'd have to think twice. But it's not, thankfully. And we can work with this. So let's look at some of the specs. Okay, we got 3 acres. We're going to look at townhomes. We're going to look at 30 units. And again, this is how we would approach any land. Does it have access to utilities? How much development does it need? What type of property are we going to put on? Is it going to be multifamily? Is it going to be residential? Is it going to be commercial? And if it's residential, what type of residential? In this case, townhomes. So it has utilities available. That's good. So it needs light development, meaning it needs to put in one street and attach in minor stuff. No heavy development, but there is some light development. So price point in this particular area for these townhomes will be $200,000 to $250,000. That's affordable these days, below affordable. Now, in the Houston area, $275,000 is considered affordability. That's low in some areas of the country for sure, but there's no more. There are very few properties out here that you can find at that price point. So right away, we know that there will be no problem selling them because there's a huge shortage in the country for affordable housing, because affordable is defined at different price points depending on what you're talking about. So this will sell by hotcakes, but we have to take into account in the affordable range, less people qualify for mortgages. So although we have 500 to 1,000 people that may want to buy these particular townhomes, but maybe 10-20% of them will qualify. So if we have 250 people or 300 people interested, we can look forward to 10% actually qualifying. And you'll notice that we can actually accommodate people that don't qualify. Because remember, our home buyer partners are tenants. And we have 2 programs designed specifically so the tenants can actually make money in our deals as well. But we'll get to that. But anyway, the market is there, no question. In this market, it will sell before we even get started. So we know this is a good opportunity. We just have to make the numbers work. So let's talk about that. We know that the price point is 200 to 250,000. So let's look at a couple other things. Okay, we got land price, 3 acres, 150,000. Light development. Now, fortunately, we know we priced some development in other areas, so we know that to put in one street and the other things that need to be done in this particular area will cost about $250,000. So we've got a total of 150 and 250 to purchase price 150 and then 250 in development costs. Total $400,000. So now we need to look within the wolf pack, make this project available. See, as a deal architect, it's my job is to structure projects so other members can participate in. So I know that I have 30 lots. I will have access to 30 lots once developed. And it's going to cost a total of $400,000 to get it there. So I need to go make that available to members in the wolf pack. Now, maybe one member to as a joint venture partner to bring that $400,000 to the table, or it may be 8 members bringing $50,000 apiece. Doesn't matter, as long as $400,000 gets to the table. But that is how we would approach it. So we need $400,000 in phase 1. So let's go back just a minute and look at our objective. So my objective as a deal architect here, and your objective as a deal architect would be to structure this in a similar fashion, utilizing the strategies in our playbook or some variation thereof. Excuse me. So our objective is I want to get at least a 15% return on investment for my JV partners. But remember, as a deal architect, always look at the risk first. Always risk first, profit second. So what are the risk mitigating factors for us in the wolf pack using the wolf pack method? Number one, we have multiple member participants to spread the risk on. No one member will ever, unless they just insist on it, but no one has to carry all the risk themselves. So that's the first way. And the second way, which is explosive, is what we call reverse wholesale. Because we have mortgage-ready landlords in our community, we use what we call a net zero strategy to virtually guarantee. Well, first of all, let me back up. The builder, we have builders in the community as well. And the builder in this particular case is going to buy every single lot. So we know we've got every lot sold before we even write the contract. So that's what reverse wholesaling is. We sell it first, and then we buy it. So we sell it to the builder. In other words, the builder agrees to buy the lots up front before we even get on the contract. There's no other way. There's no better way to reduce the risk than that. Then sell it first and then buy it. So every lot is sold. So if our cost is $400,000, we got 30 lots. That's what, 13,000 and change a piece. Great lot value. As a rule of thumb, you want your lot value on new construction to be 15% or less of the purchase of the appraised value. So at 200,000, 15% is 30,000. We're below 15,000. Great deal. Great deal. We know we can handle that. So my point is back to the risk factor. The builder is already on contract to buy every single lot before we even go through. So we know we're confident that we don't have to try to sell it. We don't have to buy it first and then run and try to sell it. In this market, that wouldn't be too much of a problem, but we don't have to do that. Not every market is like that. And secondly, when we move to the vertical or the construction, once we complete the lots, that's the horizontal development part, horizontal. We go to vertical construction, and then once we complete the construction, then we're going to sell them to our home buyer partners or retail buyers. But we have a mortgage ready landlord in place. We call this our flip safe program, that's ready to purchase the property, every single one, if necessary, assuming it doesn't take, we don't sell it as fast as we would like. But in this market, this is the hottest market I have ever experienced in my 33 years in this space. But we don't have to worry about that based on what's going on now in the market. But if we couldn't sell it in, say, 120 days, 4 months, or 2 months after completion, and the mortgage rate landlord would buy it. So we've got a guaranteed sale on every lot by the builder and every unit by the mortgage ready landlord. Of course, we structure it. We use a net zero program to do that, and we'll talk about that in another show. But these are just strategies that we use to make sure our deals are safe for everybody involved, or at least as safe as they could possibly be. And we do that with reverse wholesale. We sell it before we even buy it or build it. So that is how we address the risk. And then we talk about profit, which we'll get to. But we do have an objective. We want to get at least 15% profit on for our JV partners. But as you can see, we'll end up with 18 on this one. But okay, again, phase one, we buy the land. We got light development, $250,000, total of $400,000 that we're going to make available for the JV partners to participate in. Then we'll have the mortgage rate landlords on standby if we need them in the long run. So phase two, the builder is going to obtain construction financing. At that point, usually the land bank, because that's the land bank. When the JV partners buy the land first, then the builder buys it back from them. We call that our land bank program. That's one of the strategies in our playbook. So the builder will be getting construction financing, and at this point, the land bank participants, the JV partners that put up the money, they can choose to get their profit back once the construction financing is in place. The bank, will fund the builder, and the builder will pay them off, or they can choose to stay in the deal to make more money on the backside. We'll typically let them know, hey, there's another option. You can get cashed out now and move on to the next deal, or you can stay in this deal and make more profit on the backside. And to make that decision, it'll be a matter of, well, do I have another deal to put it into that would give me a comparable return on investment with the same risk profile? And let me reiterate the risk profile just a moment again. This is not your typical deal. Typical deal, wholesaling, you typically buy the property, fix it up or develop it or whatever, and then put it on the market and hope you can sell it. And again, this is a market that's not that bad a situation in this market. But that's not what this is. This property is already sold twice before we even break ground. So the risk profile is much smaller, lower than the former when I said we didn't have a buyer. If it wasn't sold, if we were just wholesaling, that risk would be higher than reverse wholesaling was already sold to the builder, already in the contract. In fact, they already got the construction financing in place and everything. So it's far less risk when you already have the buyer in place, contracted to buy it, as opposed to not having to buy it. So to make the same return in this case as you would on the higher risk case is just, unheard of. So understand, you have to appreciate the fact that the risk is lower, but the return didn't go down. When that happens, you know that somebody in the mix knows what they're doing. To me, that's how true expertise is defined. It's defined when the risk goes down and the return stays the same or is higher. Usually, when the risk goes up or you want more reward profit, you have to take on more risk. But when you want more profit and the risk goes down, that is the ideal situation, and that's what you want. You know, that's not always the case, but that's what we try to do as deal architects. And when you put your deals together and you structure your deals, you want to do that. You want to make them less risky and more profitable for your participants, so they know they can appreciate that, and they know that I can't get that anywhere else. So they're going to stay with you, and they're going to create long-term wealth with you. And that's what we want to show you how to do. So, builder to obtain the construction financing in phase 2, and then they purchase the lots from the JV partners that want to cash out at that time. And this could be after development. It could be, it may take 6 months to develop it. And then another, in this market, 6 to 9 months, because we got supply shortage and supply chain issues to build it. So that's why, I'm getting ahead of myself. Okay, so the builder's going to purchase a lot, and then they begin construction of the townhomes. After, of course, at this point, they've already developed lots. That was in phase 1. In phase 2, we begin construction. All right. Now, phase 3, townhomes are complete. We sell them at $200,000, and gradually raise the price as we go. That's typically how it goes. We complete the construction, sell the home to retail home buyers or home buyer partners. Now let's talk about that for a minute. We already know, as the deal architect, we put the deal together. A wholesaler within the group brought the deal to the table to the deal architect. The deal architect uses their expertise to structure the deal and their team, because remember, the team is important as well. You have to have team members, your mortgage company, your builder, your developer, your engineers, your realtors. You had to have the best in the business to execute this deal and handle all of the uh-ohs along the way, because they're all going to be uh-ohs. So you have to be, as a deal architect, you have to be an uh-oh specialist, a oops specialist. You have to bob and weave like Muhammad Ali and adjust accordingly. So the wholesaler brought the deal architect structures the deal, makes it available to the JV partner. Those are the ones that brought the $400,000 to purchase the land and then fund the light development. Have the mortgage ready landlords on standby using the net zero program strategy that we'll talk about in another show. And now be ready to sell those properties once completed, those townhomes, to home buyer partners, utilizing, well, they can straight purchase it, because not all of them, not everybody. Some of them can qualify and they're ready to buy right now, but some can't, and we can choose to. We'll already have this planned out, of course. We may choose to make some available to home buyer partners that can't qualify right now, utilizing our 2 strategies for them: the Home Now program, which is a lease purchase program, or the owner finance program, which is an owner finance program. One case with a landlord temporarily, the other case with a bank. And right now, I'd rather be the bank than the landlord. But that's a topic for another show. But my point is, In this one deal, we use multiple strategies within the playbook, or the Wolfpack playbook, and we made opportunities available for every member type within the Wolfpack. And we know there are 5 of them: deal architect, wholesale, mortgage ready landlord, JV partner, and the home buyer partner. And the team, meaning the builder, developer, realtors, mortgage professionals, insurance appraisers, engineers, they're all members of the Wolfpack. We're all here to create long-term wealth, collaborating together, doing things that we could not do on our own. That is a beautiful thing. And that's the job of the deal architect. And if that is attractive to you, then you need to visit the website and join our free community called the Wolfpack. Now, let's talk about the profit distribution. Once the homes are completed, remember, we purchased the land, we developed it, we built the homes, and we sold them to our home buyer partners utilizing the Wolfpack method. Now it's time to distribute the profits. And again, we're not going to discuss on this show about the mortgage ready landlord. We're going to assume they're all sold. We didn't have to buy any ourselves through the mortgage ready landlords. So the only person to distribute profits to is the JV partner or the joint venture partner. So they get their, in this case, they get $400,000 plus 18% cash on cash return. That's a total of $472,000. But here's how they get it. They get it one house, as each house is sold and closed, they get a part of their principal and part of their profit back as each home is sold. So that's, in this case, $15,750 per home sold. So 30 times 15,750 is approximately $472,000, which includes the principal and the return. So we have to get the return of investment as well as the return on investment. But it's up to you as the deal architect to structure it this way or perhaps another way, utilizing the strategy or perhaps other strategies, and execute to make sure everybody wins. All members win. And when you can make sure everybody wins, you're doing your job. And as a deal architect, as I teach, as we do it, everybody has to win. Everybody. And we look at risk first, profit second. So as you know, we talked about the risks extensively during this deal. And we talked about the profit at the end, because if the risk profile is not amenable or palatable, then we don't have anything else to talk about. Risk first, profit second. So let's review. We've got 3 acres of land. At first, we talked about what we need to look at first. We need to know, are there utilities available? Of course, there are a lot of little things, other things to look at, but in summary, we can't teach everything in 30 minutes. But we want to know if the utilities are available. And we want to know what type of development we have to do and get the costs available. That's where we got the land price of $150,000. We got the development cost of $250,000, $400,000 to get it done. Now, the real expertise or the real thing that's going to help you learn the craft of deal architecture is the story behind this, the experience along the way, the nuances between the tactics, between the strategies along the way. So once you join the Wolfpack, and you begin to work with us, we'll teach you in real time the craft on a real deal. And so you can learn from the real experience of a deal architect as they tell the story. And of course, you'll be making a profit as well, because more than likely you'll be playing the role of the wholesaler, because you either brought the deal to the table or some of the participants to the table. That's wholesaling. But you get to learn the craft in real time, and you get to make money in real time. No better way to do it, as far as I'm concerned. So that's the situation. And then we went through phase one. Well, here are the specs of the deal. We want to do townhomes. We determined that what type of property do we want to put on the land. Is it commercial? Is it multifamily? Is it residential? If it's residential, what type of residential? Is it single family? Is it duplexes? Is it patio homes? In this case, townhomes. Could be condos. All of those are residential. Townhomes here. How many? How many can you fit on there? In this case, 30 units. The price point is 250,000, but we're going to use 200,000 because we have to take into account what the market can afford in that area. Now, we may be able to, it may appraise for 250,000, but if the buyer can't afford 250,000, it's useless. We have to be able to produce a product that they can afford and still make it a win-win for everybody. And in this case, 200,000, the lower end, the numbers work and everybody can win. And then we look at the objective. We want to know, what are we trying to accomplish? Because once we determine what we want to make available, the opportunity available to the participants, in this case the JV partners, then we usually start with a one-page profile. We show it to them so they'll see the flow, what role they're playing, what the risk is, and what their return is. And they say, hey, we like that. Then we show them the details. Show them who the team is, why they're qualified to do this, what the plans are, the data, so they can make an informed decision. And we educate them along the way. You got some members that want to learn everything, and that's perfectly okay. I'm an instructor by nature. I'm a teacher, so I'm a coach. So I'll teach you as much as a deal architect, as much or as little as you choose. And then we got some participants that don't want to learn anything. They don't have time. They have jobs and families to take care of. But we insist, and they know this, that you monitor your project, monitor the metrics, monitor the performance of the project, so you can make sure and be informed that everything is going along as planned. And if it's not going as planned, that the contingencies are in place and implemented and executed to make sure it gets back on plan. So as long as you're doing that and you don't want to learn anything, it's okay with us. You don't need to be actively involved in the day-to-day in order to participate, but you most certainly can. And you can play multiple roles. You can play one role, but you must play one role. You can't just play no role. You got to bring something to the table. Okay, so that's the specs of the deal. Phase one, again, we begin the development. Phase two, we begin the construction. Land bank is paid off. Now, I will, and then phase three, we sell it. And then we close them and we distribute the profits. Now, I will say this. Well, in summary, let me say that if you know someone that has land and they'd like to sell it or joint venture with us and make a profit, because if they joint venture with us, they can make more profit on the back end. They just want to sell it, it's up to them. But either way, you know where to go to get the job done, to earn your profits, to create your profits, and to create your long-term wealth. And this is just one way. Every week we'll be coming with different ways to structure deals in the wolf pack. It's all available in the wolf pack for you. If you know someone with land they'd like to sell and you like to make money on it too and learn the craft or not, join the wolf pack and bring the deal. Share your experience with us so we all can learn. We have deals going on every day, all day, by several members at all times, all across the country. We're heavily concentrated now at the time of this class in Texas and Louisiana. But we're moving, we're putting boots on the ground now in Florida. And we're putting boots in the ground and, looking to put boots in the ground in other areas. But we have members all over the country. Some in Canada, some in Mexico. So if you're interested in real estate, join us in the Wolf Pack. We'd love to have you. Send your questions. Go to the website, put your questions in. Put in the comments what you'd like to see, what you like, topics you'd like to cover. Put your deals in, deals you like us to chop up. And we'll be here every Thursday at 6:30 Central Time on Deal Architect Live, chopping them up. Join us next week. Same bat time, same bat channel. See you then.